Hello, everybody. My name is Jo Haigh, and welcome to our webinar on demand, preparing for your business for sale. Just quickly, a little bit about us. We're actually celebrating 36 years in business this year. We are an EOT, and we were formerly an owner-managed business, but 5 years ago, I transferred the ownership of my business to my staff. We work probably sector agnostic, but our speciality is definitely owner managers. We used to say we are one, and of course, we still are one. It's just that the owners are now my staff. So just a little bit about myself. Like all entrepreneurs, I started my business back in 1989 from my back bedroom. And as I've already said, we've transferred the company to the staff in 2020. I've won a few awards and I'm non-exec director of a number of companies, and we've been involved in well over 400 transactions over that period. I'd like to introduce you now to my colleague, Poonam.
Thank you, Jo. I'm Poonam Kaur. I'm the CEO of FDS. I've got over 25 years of experience in accounting and corporate finance. And alongside Jo, it's myself and Jo that lead on all the projects and transactions here at FDS. As you can see, our largest transaction to date has been $72 million. However, our average deals are more in the scale of 1 million to 20 million. I'm also the chair for the IOD West Yorkshire region, and I also hold several other board positions. Just like Jo as well, I have won a few awards as well. Um, Thank you, and look forward to talking you through preparing your business for sale.
Okay, having been involved in hundreds of transactions, including three of my own sales, one of the things you don't want to suffer from is what we call vendor remorse. So you need to remember there is a life beyond the boardroom, but the time to start thinking about that is before you go through this process. Who are you? What are you going to do? Believe me, playing golf and going on holidays only lasts so long when your baby has been your business. So, why are you going to sell? What are you interested in doing afterwards? And it could be for various reasons. There might have been a shareholder fallout, or you just don't want to do it anymore. There's all sorts of reasons. Maybe you want to realize some value. But understanding what you are going to do past that boardroom and why you're selling is a very important part of the process. So, there's lots of things that you need to think about to make sure you can do the best possible deal. And none of us like tax or paying tax. And at the moment, we have so many changes going on in the tax world, it's hard to keep abreast of it. But planning your tax process in this is key, particularly if you're selling part of a business, for instance. Is it a division or is it a separate company? Is it a wholly owned subsidiary of your business? There are things that you need to do regarding the most tax effective way to dispose of that business at the start of the process. Also, this transaction process can take as long as 12 months specifically for a trade deal. So you need to prepare yourself for a long journey. And that journey is full of bumps. I wouldn't say that Poonan and I have seen everything, but we've certainly seen some interesting things happen. And you need to build up resilience. Because of everything that's happening in the world and with our government, crystal balls have all, at best, clouded over, but most of them are broken. So you have to expect the unexpected. And in that, you need a good team who've seen organizations go through this thing before and how to manage that. One of the things I would highly recommend is that you tell your closest friends and your family what you are going through, because it really is personally very challenging. Things very rarely go exactly as planned, and you need not only a great team to rely on, but you need your family and friends. So take them into confidence. and then you have got somebody to talk to. So, valuation, and for those that are interested, we are running a separate webinar on demand on how valuation is actually calculated. But I usually like to say it's like beauty, it's in the eye of the beholder. And what I mean by that is that not everybody will value your business in the same way. We've sold businesses mostly in what we call a controlled auction, where we put out information memorandums to a number of people and they come back with a bid on the back of a document that we've prepared for our client that gives our estimation of value. Now, to be fair, most valuations come back in that arena, but we have had examples where there are basically people kicking tires, just want to have a sniff around, and therefore their valuations have come in substantially under what might be acceptable. But equally, we've had valuations come in from buyers who really want that business, and perhaps it's the only one on the market that suits them, perhaps it's in a specific area, perhaps it's got the people that they really want, and therefore they are prepared to pay more. So that's what I mean by beauty. Now, there are multiple ways of valuing a business technically, and I say technically because eventually the valuation is a negotiated position. But one of the most common is a weighted, normalized average of EBITDA. So a few words there that you might not be familiar with. Normalized means to take out all those non-recurring costs of which most private businesses have, well, quite a lot sometimes. It might be traveling first class, or it could be subscriptions that somebody else wouldn't use, or it could be family members on the payroll. So that is normalized out. And then EBITDA is profit, or we call it earnings, before interest, tax, depreciation, and amortization. Amortization, by the way, is just a posh word for the depreciation of an intangible asset. So we find out the weighted normalized average of that probably over a period of 3 years, and then we will apply a relevant multiple. Remember, this is just giving you a technical valuation. Now, multiples vary tremendously by companies. Some company types are more in vogue than others, and we have access to a live database that tells us who is buying what and what price multiples they are applying to those deals. So we can look specifically by your actual company. However, the average deal size as we go today, which is February 2026, is 5.3 times. Don't go away and think, oh, my business is worth far more times than that or far less. This is just an average. If we value your business, we will actually find a specific direct comparison. If you've got lots of assets, say hotels and quarries, for instance, um, the other way of valuing business is to look at net assets. Net assets is the sum of all your assets on your balance sheet, less all your liabilities. But of course, assets on balance sheets are valued at net book worth. That's purchase price less depreciation. That is not the same as market valuation. So we would look to make sure there is some alignment on the net assets on your balance sheet and actually what's going on in the marketplace. For instance, if you've got buildings that say you've owned for 25 years and you're depreciating them at 1%, which wouldn't be unusual, perhaps those business assets, those buildings are worth far more than that. And then we add goodwill, and goodwill, that really is, a fairy-like number because goodwill depends on all sorts of things. It could be the quality of your people, it could be your income stream, it could be specific IP, and we use our skills to estimate that. And then, of course, there are industry specifics. So, for certain business, so for instance, a IFA, those are valued on multiples of income, as are SaaS businesses. And those methods, we usually will look at what is the most appropriate for your business, but we might look at two or three just to gauge that we're in the right ballpark. Okay, I'm going to hand over to my colleague now to talk to you about what we call the golden nuggets of value in a business, which go far beyond the numbers. Over to you, Poonam.
Thank you, Joe. So, as Joe mentioned earlier, the value that we can create from a valuation is a mathematical and technical calculation, whereas worth is something is dependent on the person who's looking at that business, and it's what someone is prepared to buy at and what one is prepared to sell at. So that's where worth comes into place compared to value. And what we do in terms of when we're looking at businesses is to assess actually where is the worth in this business and what can add value to your business. So rather than just looking at a profit and loss account and your balance sheet to assess the assets and the liabilities or the profits that the company is generating, a lot of value is sometimes tied up in items that are not visible by just looking at a P&L or a balance sheet. So one of the things that we'd like to look into and go into depth with businesses is looking at their management team. Is the business reliant on you as an owner? And if it's not reliant on you as an owner, then that will increase value if you have a management team in place that run the day-to-day operations of the business. And furthermore, if they are making strategic decisions as well. Um, Additionally, customers, we need to see if you have any kind of recurring revenue in the business, whether there is contracted revenue in the business. As you can probably imagine, if there is long contracts, say 3 to 5 years with customers, that is kind of a guaranteed income that's going to come in the business for the next few years, and therefore that will add value. Now, if there's high concentration in one customer, say, 80 or 60% of your business is with one customer, that actually, can have the negative effect on a business valuation as well and the worth of that business. Because if that customer was to leave, then that might leave a big hole in your current operations of the business. IP and infrastructure, things that you've built into your business, the systems and processes, they can all add value. And while it might be initial cost that the business has paid, in the long term, that will always generate a return. Um, Also, looking at your products and services in terms of what your business does, are there any USPs? Do you have any kind of um, 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 products or services that are a leading product? So things like, we say about like the Apple iPhone, there is brand value attached to those kind of gadgets, and that's what we need to look at. Is there any kind of brand value in your business, and would that add value for anybody who's been interested in buying this business? Would that bring them additional value too? And it can be things like location of your business. People are just trying to take, a geographical space that you might dominate in, and that can add value too. So it's about looking at, those aspects of your business. And then, finally, the financial performance and strength. So one of the things that, can really add value is if you've got a cash cow kind of a business and that requires minimum working capital, that can all add value because you're not having to service the working capital. And e-commerce businesses are quite high in financial strength because a lot of the time customers will be paying up front for goods that, whereas, as a company, you might not even have in stock, or you might be not having to hold that stock, and it can go direct from supplier to customer. So these are all different aspects of a business that add value and what we call as golden nuggets. Thank you. Back over to you, Joe.
Okay, so I think it's interesting to understand that there are multiple ways of exiting your business. There's not just a straightforward trade sale. And even on a trade sale, you don't have to sell to a competitor. It could be a horizontal or a vertical sale. So it could be sold to a supplier or a customer. In fact, sometimes those deals produce better value because the marriage value is worth more than a straightforward trade comparison. And of course, you shouldn't just think within the UK borders. Over our years of trading, we've done many, many international sales across both Europe and America. So there are opportunities on the worldwide basis. The exit option can often give you the best value, but it is the one of the processes that takes the longest time. So the next one is a private equity sale. Now, private equity and venture capitalists are usually only interested in larger transactions. Basically, if you're not making a minimum, and I really mean a minimum of £1 million EBITDA, even that would be a small transaction for a private equity investor. There are regional players, of course, out there who may be interested in smaller deals. These deals are very different because the investor now is looking for a quick exit. Generally, they want to be out within 3 to maximum 5 years. Rarely will they take an aggressive stake. They usually want a minority stake, but they also want control on that. So even if you've got a private equity investor with, say, 25% of the shares, they will feel like a 75% percentage investor because of their investment rights. They'll put somebody on your board and they'll leave you alone if you're doing fabulously, and they'll be all over you if you're struggling. It sounds like I don't like them really, but actually they do have loads of money and their deals can be quicker, but it's a marriage that is very difficult to get out of, particularly on your terms. One other route is a management buyout, which I'm sure most of you will have heard of. And this is where your management team buys the business. There's also something called a bimbo. It's not some blonde on the webinar, by the way. A bimbo is a buy-in management buyout. So that's getting your management team to join up with a buying candidate. And that actually can produce even a sweeter deal because the banks like that because you've got a management team who are known to them, the customers know them, and then you've got a buying candidate who can bring additional opportunities and even money to it. Um, Trouble is with management buyouts is the management team rarely have any money. Sometimes the buy-in candidate, if you convert into a bimbo, can actually bring money to it, but that often means that the vendor may have to take a different view of getting their money out. There might be more vendor loans involved. A Vimbo is actually like a management buyout, but it's a more collaborative event where the vendor and the management team work much closely together to secure finance, to secure too fair a deal, using one set of advisors who need to be wary, that they're dealing with people who may want different things. But that can work very favourably if both parties understand that this is the deal that suits them both, and the word both being important. So I mentioned at the start of this webinar that we are an EOT, an employee ownership trust, and that is where the vendor transfers their business to the whole of their staff. That's not the same as a management buyout where it might only be a number of staff. And it is still the most tax efficient way of transferring that business to your employees. Because while our current Chancellor did attack the tax-free position of EOTs, she has actually put it at 50% of all other tax routes. So it's still the most tax efficient and it's by far the quickest route. We do have a separate webinar on this for you to listen to if you're interested. So that's just a little bit on the timing, so you can see the employee ownership trust tends to be much quicker. While we've got 9 and 12 months for both trade deal and private equity tends to be a little bit quicker, most because they're set up to do lots of transactions and they'll have very effective due diligence teams, etc. But that's all these are sort of estimates. So on tax, and this is a movable feast at the moment, what we used to call entrepreneurs relief, now called business asset disposal relief, may be available. There are all sorts of caveats around that, but we can advise you on that. Exactly the same with private equity transactions, and exactly the same on management buyouts, bimbos, and vimbos. On employee trust, as I said to you earlier, while this has been attacked, it's still 50% less than any other trade exit or private equity exit or management buyout exit. So it's still the most effective in terms of tax, but tax isn't the only area. I'm going to hand back now to my colleague Poonam to talk to you about the sale process for trade and equity.
Thank you, Jo. So, when we're looking at the sale process, whether it comes to trade sale or a private equity sale, they both carry the same kind of process. For any kind of transaction, the first step would be for us to undertake a company valuation. It's really important for selling shareholders to understand where does the company sit? You know, if we were going to open market and we've talked about a technical valuation and worth, a company valuation, whilst it's a technical valuation, does give us a basis. And what we really need to understand is that, you know, is this aligned with the selling shareholders' expectations? So it's really important we do undertake that technical valuation because anybody who's looking at buying that business will start off with a technical valuation too. And then we'll look at it in terms of, well, is it worth more to us or worth less to us from that perspective? The second thing that we want to do is, get in early because planning is quite key, and taking the relevant tax advice is critical. At the end of the day, when we're looking at any kind of transaction, we want to ensure that we can um, um, have more money in the pockets of the selling shareholders, the staff, or the team rather than a taxman's. So tax advice is critical. And as part of the process, there's really three documents that we have to get ready before we go to market. And those are pulling a specific target list together. Who are the buyers going to be, the possible buyers for this business? And we cast the net quite wide. What we want to really establish is get as much as possible buyers involved in any kind of transaction. And because we work with a timeline process, we will pull together a criteria that we want to focus, pulling that target list together. So it's targeting buyers. And there's buyers out there that might have the desirability but don't have the affordability. So in our team, we and our project assistants, they will look into, okay, these are buyers that fit from a good fit perspective, really good, but they will then check their financials and understand, do they have the wherewithal to make those transactions? So a specific target list of buyers. We would then pull together a teaser document. A teaser document is a one pager on a no names basis. So this will not share the company name. It will talk about the industry the company works in, the reason for sale. It'll talk about the key strengths of the business, the key financials. But that's an enticement. So when we're going out to buyers, we want to ensure that, does this really entice the interest that we want from a buyer? And if so, because it's on a no names basis, we keep this confidential at this stage. And if they are interested, at that stage, we would get them to sign a non-disclosure agreement before we reveal the company name. This keeps everything quite sensitive because when you're looking at selling a business, it can be a very sensitive process, and a deal's not done until it's done. And what we don't want to do is upset the business or the team members because any kind of change can cause a disruption. So this is all managed in a sensitive way when we're working through a sale process. Once we have a non-disclosure agreement in place, the third document that we would be preparing beforehand is an information memorandum. And an information memorandum is really the Bible of your business. What have you built today? This talks about the history, the makeup, the customers that you've got on your database. It talks about the suppliers that you have in place, the team, but more importantly, it talks about the opportunities that this business has. So a buyer will always look at a business not just only from, okay, what have you done today, but actually where can this business go? And why would this be really attractive for us to acquire? So it's about, yes, getting all the factual information there, but also really talking about the future opportunities with this business and what that can bring. Once we have all those three documents ready, so the target list, the teaser document, and the information memorandum, we are then ready to go to market and carry out those steps of picking up the phone to these buyers and getting them to see the teaser document, getting them to sign the non-disclosure agreement, and then sending out the information memorandum. Once we've been able to share that information, what we really want to do is then, get speaking with these buyers and see, right, okay, we've sent you this basis of information. Are you interested in exploring this further? And from that, we will be putting together management presentations where actually they get the chance to assess us, the company that we're selling, but also it gives the sellers the opportunity to look at and ask those questions of the buyers. Depending on the reason for the sale, it could be a retirement sale, it could be actually you're looking for a big brother or a big sister to take the business to the next level. But it's a two-way communication. And if it's a retirement sale, a lot of buyers will want to make sure that if they've built their business, their baby for a number of years, that it can be really be looked after by the next owners as well. So that's a really important factor when we're looking at engaging with buyers and what they can bring to the business and how that looks. Along with, of course, we're interested in deal value and deal structure, but they are the other elements that are considered as part of that transaction. Throughout our process, we do have a controlled auction. So, as I mentioned, it is a timeline process. When we go to market, we normally need at least 12 to 13-week gap for us to speak to these buyers, have the management presentations, and for us to ask them to place their indicative offers by a certain date. And normally it's at that 12 to 13-week timeline. So when we send the information memorandum out, at that point in time, they will be aware of when indicative offers needs to be placed by. So we never put a price on your business because as soon as we do that, that's the most you're ever going to receive for the business. And different buyers, as we've discussed already, will have different views on the worth of that business. Jo and I were involved, we've done over 450 transactions, but one particular deal that we were involved with, we had 8 bids for that business, and they varied from 800,000 to 5 million. We had valued that business around the 3.5, 4 million mark, and a lot of the bids came in that range. However, the one at the 800,000 bid was just a chancer, and they were just trying it on. They weren't really interested. They were just trying their luck. But then the bids that we had received a couple of bids around the 5 million mark. They really wanted the business because what that would bring to them would be worth a lot more than where we had done the technical valuation at. So this is what we mean in terms of a controlled auction. And the first bids are never the final bids. So it's our job as advisors to maximise the outcome of those bids that are placed. And whilst sometimes a higher number can be more attractive, what we really need to be mindful of that it's not just the deal value. We want to look at the deal structure of that business because when we're looking at just deal value, somebody might offer you 5 million, but they might say we were going to pay that over 10 years. So sometimes you might want to go with a lower bid. For example, if it was a £4 million transaction and they say we'll pay you, 3.5 on day one and 500,000 a year later, well, you might be more willing wanting to take the £4 million deal than the £5 million deal just because of how that deal is structured. And then once we've got to final bids, at that stage we need to go with the chosen bidder. We would keep buyer B, buyer C warm, but heads of terms have to take place, and the heads of terms document is not binding from any other aspect other than we give them exclusivity. So the chosen bidder has exclusivity to complete the due diligence and the legal requirements for completion within a set period. Normally, on average, you're looking at probably, 8 to 12 weeks for that period where we cannot speak to anybody else. And from that perspective, we really need to just ensure that when we are looking at any kind of transaction, we keep the deal momentum going at all times. So once heads of terms are signed, we move on to due diligence, and then the buyers would carry out all their due diligence, and the legal paperwork would happen simultaneously to completion. Okay. Now, the MBO process and the VIMBO process, as Jo said, this is very, you're not speaking to any third party here. You would normally know these individuals from the get-go. So on this process, this is quite a bit more streamlined to trade sale and private equity because, the first thing that we really need to do is agree the value of the business and the deal structure. And that can be very much a collaborative approach when it comes to a management buyout and a VIMBO. We need to understand actually, is the selling shareholder selling 100% of their shares or are they going to do it in stages? And that needs to be agreed. If we're looking at, going for any third party funding, if the selling shareholder isn't prepared to wait for their funds, then we would need to put into plan a strategic and financial business plan to go to funders to raise any finance. We'd look at considering offers for various funders and negotiate the best terms. And once that's all in place, there is the legal and tax advisors that we would need to complete the transaction. Moving on to the next. So an EOT process. With an EOT, again, this is the selling shareholders selling to their team. Again, not a third party. So the first thing we really need to assess is an EOT right for the business? This can not solely be just focused on, the tax efficiencies that comes with this. It's more about, okay, what is the long-term plan for this business and where do you want to go with this? So the first thing we have to do is assess whether it's right for the business. Secondly is a company valuation because with this process, there is HMRC approval required. It is a HMRC approved scheme, so there is a process that requires HMRC approval. So we do a company valuation, we assess what the business is valued at. We want to ensure that, okay, is this going to sit right with the employees and the management team? We then need to look at a feasibility modelling, which will investigate whether the selling shareholder is selling 100% or, just over 50%, because there is a set requirement that with an EOT, you have to sell over 50% for it to be an EOT. Once that's been agreed, we go to revenue approval with the set headlines of what we're trying to achieve. A payment plan is structured and drafted and agreed. Then we need to ensure, okay, what is the role for the vendor? Is the selling shareholder going to remain in the business or are they going to exit? And with this process, it's quite common for the selling shareholders to remain for a period of time. Um, we would need to set up a trust company for the EOT, so that is a separate legal entity that's set up that holds the shares, and we'd have to complete the necessary legal and tax requirements that are required. We would also need a trust board that's set up with an EOT process as well. Um, and as part of our service, we do provide internal communication plans because communication is quite key. It's really important to inform employees of what is changing, but also what is not changing. With an EOT, not all employees, become directors or run the business and have direct shares. So it's really important to communicate clearly what an EOT is. And we can help with external communications if necessary.
Okay, well, as you can see, there's a lot to think about in terms of which route, which suits you best. Do you want to stay on? Do you want to leave? But just some things to finally say before you actually make the decision. First of all, start with evaluation. I don't like necessarily to compare myself to an estate agent, but you wouldn't just put your house on the market and say, make me an offer, would you? Without having some idea of what it's worth. Now, we can give you a professional, robust valuation. We might not sell it. We may sell it for more. You may decide to take less. Not unlike an estate agent, but at least you've got a marker in the sand. And then, because we want to maximize the value of that business, I want you to go through and look at your profit and loss account, take out anything that is discretionary or one-off costs, and that will get us down to normalized value. Make sure all your records are up to date. That is hugely important. So if you don't do monthly accounts, then I recommend that you start to do those because we cannot work on out of date information because of the time it takes to do a deal. We need information that's absolutely up to date. Look at any of your outstanding debts and finance obligations because businesses are valued cash-free, debt-free. So sometimes it is an idea to pay down your debt in advance if it's possible. Look at all your contracts and leases and look at to see if you've got any anti-novation clauses. And by that, I mean, if the business changes hands, do the contracts not necessarily transfer over? The time to negotiate that is not while the people are in due diligence, it's before you go to market. Check all your IP, make sure they are properly registered and copyrighted over the areas that you want. And of course, because for most people, the staff are hugely important on a takeover. Do you need to give them some sort of incentive schemes? And there's lots of things. It doesn't have to be real shares. It can be long-term incentive plans or enterprise management incentive plans or all sorts of things to keep them tied in. And as well as if they are going to leave, you need to look at their restrictive covenants. Nobody goes into a data room and says, this business is worth so much more than I thought. Do you want more? They go in it to chip. So make sure your processes are as effective and robust as possible. It might not get you more money, but it will definitely hold the contract together. And finally, deals take a long time, they're exhausting. You need to keep everybody in control. Make sure your information is as accurate as possible. Make sure it's up to date. Keep everybody motivated because while you're not necessarily going to tell your whole team if it's a trade sale, you are, I hope, going to tell your top team at the appropriate time because you're going to need them. And you need to keep them happy and you need to keep them motivated. And whatever you do, don't give up your day job. Now, if you've done this properly, you'll have made yourself the least most important person in the business. But if it doesn't sell, you have to go back into this business. And therefore, don't do anything different to what you would normally do if you weren't selling the business. And finally, a statement that really comes from the military, which is plan for the worst and hope for the best and rely on your advisors to keep this momentum going. We have a little saying in our business, delays cause disaster. If you're interested in finding out any more about us or would like to have a completely free, informal or formal chat, please scan this code and we'll be back in touch with you. Thank you so much for listening and goodbye.